At Canaccord Genuity Wealth Management, as we review the world economy today, we see increased evidence of widespread and sustainable economic growth. In the United States, where already we saw an economy approaching full employment, we now have the effects of the Trump administration in the form of tax reform, tax cuts, infrastructure spending, and potentially the repatriation of cash held overseas. Meanwhile, in the UK, we see as yet few signs of the worst effects that the doomsayers forecast after the Brexit vote of the middle of last year. In fact, consumer spending has held up remarkably well. Although, of course, we have yet to see whether the actual triggering of Article 50 has the negative effect that some think it may. In Europe, meanwhile, we see continued progress, albeit off low levels, towards steadier and more widespread economic growth across the continent. And in China, despite recent moves to tighten economic conditions from the central authorities, growth continues apace. This stronger economic growth is finally beginning to show through in inflationary pressure, whether it be through higher energy prices, higher commodity input prices, wage pressures in industry, or in the UK, from the devaluation of sterling. With a combination of stronger economic growth and inflationary pressures rising, we see the probability of the US Federal Reserve raising interest rates at its next meeting as increasing. And there are further economic data points in the near future which may seal the deal in this regard. So how does this impact our asset class positioning? In equities, where we view valuations as on the high side, we still maintain a decent weighting. The reason for this is that the pro-growth agenda that we see unfurling across world economies should drive earnings growth in the next 12 to 18 months. We continue to play the same themes we have followed for the last 6 months. Namely, in the United States, financials and industrials, and more globally, healthcare and infrastructure. Meanwhile, in fixed income, an asset class we have not liked for some time, we think there is further room for yields to continue to rise in US Treasuries and UK gilts. However, we think there is some limit to this upward rise, and in due course we should be looking to widen out our exposure to this asset class. Finally, in alternatives, we see good opportunities to continue our strong weightings in the area. In an environment of low asset class returns more or less across the spectrum, these assets generally provide strong risk-adjusted returns for our clients. We would like to use any potential pullbacks to add to positions in risk assets should these occur in the face of political risk. And over the next few months, we see plenty of opportunities for political risk, with elections in Europe and the unpredictability of the Trump administration.